Hi, David.
Hi, how are you?
I'm great. Listen, I really appreciate you talking to us because, as I told you before, I'm numbers phobic and you're not. And this way, you can share with folks out there on the North Shore a little bit about how to manage some of the most important numbers in their lives associated with money. And first, I just would like it if you could please share with me what it means to be a portfolio manager. What does that job entail?
Well, being a portfolio manager means that people are entrusting their assets to you and that you have to do the very best job you can to safeguard and grow them in accordance with their risk tolerance.
Okay. And what does that mean for the layperson?
That's what it means for the layperson, is that we safeguard your assets and grow them to your risk tolerance to the best of our ability. And our due diligence is to make sure we know what we're doing and that we don't put you at risk.
One of the things that we talked about as we were leading up to the interview is that regardless of how old you are, there's always kind of a driving force behind what you may want to do with your money. But the things that you shared with me is regardless of what stage you are in life, you have kind of these three guiding principles that you use and I guess you live by in your profession. Can you share those with us?
Right, I have my three, what I call my three laws of investing. The very first law, and it may seem self-evident, is the future's unknowable. We can't, the future's unknowable because it's something we can't know. The second law I have is that the market statistics about the financial markets tend to be persistent, which means that relationships that are existing now between different asset classes or different instruments will tend to persist the same way going forward. They do change and they will change over time, but they won't change overnight. The but that's an assumption that I use in my portfolio management. The third law that I have comes from a famous Nobel laureate from the University of Chicago named Harry Markowitz. He developed modern portfolio theory, and the idea there is minimal variance portfolios are optimal, which means that the best way to set up a portfolio is so that it has a minimal amount of ups and downs.
Right. And the reason why we're talking about that is because you don't make predictions, right?
Well, the future's unknowable, so
Right.
making a prediction about what's going to happen is hit or miss. Now, maybe there are people who are smarter than me. I'm sure there are many, many people who are smarter than me in this industry
I don't think that's true.
who who will be correct in their predictions, um, and and maybe they have some way of doing it, but I prefer not to do that.